Hey guys, welcome to another video and thanks for clicking on this one. In this particular one, we're going to cover the recent economic data that came out today, and that is the initial jobless claims. Now, I covered this on Sunday when I was setting the expectation for the week on data that will come out and could likely impact the stock market, and in particular, how this data could influence how the Feds make decisions going forward in regards to rate cuts. Now, the data for today is the initial jobless claims, and it came out and it wasn't dramatic. And what do I mean by that? Well, it came out to be slightly higher, but it wasn't anything crazy. Now, in as much as this is a good thing for people and consumers that are working, this isn't a good sign for the Feds. The Feds are, in this case, waiting for this dramatic data that would push them to start cutting rates, but that is not what is happening. Now, we're going to get into the details in this video, but before we get into that, if you're new here, welcome. If you're a returning subscriber, thanks for clicking on this video. This one is just to break down how this economic data would impact the market and how, of course, how we can make money and position ourselves for the gains. So if that is what you're interested in, please stick around by subscribing. Don't forget to drop a like on the video. Please, it goes a long way and I would appreciate that. So let's get into it. So the initial jobless claims for the week ending August 2nd came out to be 226,000, which was up 7,000 from the previous week. Previous week's claims revised up from 218,000 to 219,000, so very minor change there. The 4-week moving average is down 220,750, with a slight decrease, about 500 from the initial numbers. What does all of this mean? Well, if we could go back about a month or so, we were looking to see some dramatic changes in the economy, that the economy will slow down, and in as much as the numbers are showing to be slowly trickling in with GDP reducing and exports decreasing and imports also decreasing from the data from last week, we also need to remember that the unemployment data came out to be about 4.2%, which was showing to be slightly higher. And according to people, they were saying, well, if these numbers continue in that direction, well, especially when it comes to employment, they believe is that come September, the Feds will want to lower rates. Now, with numbers like this, that isn't dramatic. The problem is that the Feds may not have a strong signal to start cutting rates. Now, we still have a few weeks before the meeting in September, and maybe some of this data will start to roll in to hopefully push the Feds in the direction of cutting rates. And that is really what we want. But remember, the Feds have two important mandates, which is the employment stability and, of course, inflation. So those two things are the goals that the Feds are working towards, and they are trying to get to that. Now, the president, of course, wants the Feds to cut rates right away. But we also know that tariffs that are coming into effect as of today will not help the matter. According to experts and analysts and economists out there, they are projecting that, yes, in as much as these tariffs are coming in, consumers are likely to pay 60% of the cost of those tariffs, and the producers or manufacturers will heat up about 40%. So profits will go down and consumers will pay more. What does that mean? It means that inflation is likely to tick higher come early next year. Now, the problem with all of this data that we look at is they are always backward data, in the sense that they are past data. So like the one that came out today was for the week of the August 2nd. Now, this is still more recent because this is something that comes out every week. But majority of the unemployment data that comes out, the GDP data that comes out, this data are sometimes 2 months old or a month old, which means for us to see the impact of these tariffs that we are getting today, or at least going into effect today, we might not see that impact until 2 months from now. And guess what? The Feds try to meet, planning to meet in September. The projection is that they should have a rate cut at least twice this year. That may not happen because if these numbers don't come in quickly enough and are not strong indicators of a slowing economy by unemployment going up, then they are likely not going to do anything. And that is not good for us consumers because guess what? In order to borrow money, that won't help. And of course, it's not going to help businesses. Now, one of the things I was mentioning is that come early next year, the tax cuts by the president may incentivize the market, may help to offset some of the costs, like the tax cuts that companies will get and some individuals may be able to qualify for. We all don't know how that will play out, but this is something to definitely keep in mind. Now, where does that put us? Well, this puts us back to where we were the Feds may not be able to cut rates because of this type of data, because it's not strong enough to show that the economy is slowing down. The hope is that we're able to get more data, and that data is able to support the decision of cutting rates. So how has that affected the stock market today? Well, one of the things to remember is that when the stock market opened today, the Dow, Nasdaq, and the S&P 500 all rose to higher levels, but quickly sold off. And the reason why they've sold off is two things. One, of course, the tariffs that came into effect today. The hope by investors is that the president may come up with another delay or some form of agreement with these countries, and hopefully they are able to work a deal out before August 7th, but that didn't happen. The second thing is that this initial jobless claims that came out today isn't strong enough, and this is one of those good news but turns out to be bad news for investors, because at the end of the day, the stock market is looking for that rate cut in the market, and if there's going to be a rate cut, this would obviously boost the sentiment of investors, but that is not going to happen now. And that is one of the reasons why the market has sold off. Now, are there opportunities in the market? Of course, there's always opportunities in the market. If you're somebody who is interested in Lilly, LLY is the ticker symbol, the reported earnings did an amazing job with the earnings. However, they did share some data on their clinical trial on one of the drugs that they help that is used for obesity. And they said that the trial didn't really go as planned. Guess what? The stock sold off almost 14% at the time of recording this video. This was a stock that was around $700-800 at some point, and it's down to around $600 because of this. Even though the company is making strong earnings, making good profits, just because of the clinical trial that didn't go as planned has caused this stock to sell off. Do I consider this an opportunity? Absolutely. This is a company that has been in existence for a long time. They've made very strong, reliable products, or at least pharmaceuticals in the pharmaceutical world and over time. But there's a problem. The problem is that the president has issued a warning that if these pharmaceutical companies do not start to make their drugs in the US, they are likely going to get tariff implemented or at least imposed on them. And that is not good for any company. So we'll see how that plays out. It's given a deadline of September 29, if I remember correctly, and I hope that these companies will do the right thing. But if you are somebody who wants to buy and hold great companies for the long term, in my opinion, this is one that you may want to add, even if just a little bit, and watch it grow over time. This is not a quick rich scheme, but it is something that you can rely on from a reliable company. Well, I wanted to share this information with you. If you have found value in this one, please don't forget to drop a like on it. It goes a long way, and I'd love to see you in the future one.